Now that we have learned the basics involved in analyzing a set of financial statements, let's begin to apply these skills to the real world by analyzing a set of real-world financial statements. In this video, we read and analyze key financial numbers published by PepsiCo as of the end of 2016. Here are the 2016 financial statements in summary form of PepsiCo, the well-known global food and beverage company. Focus first on the January 1 balance sheet, which shows assets of $69.7 billion, liabilities of $57.6 billion, and an owner's investment of $12.1 billion. By year-end, December 31, assets had grown by $4.4 billion to $74.1 billion. Liabilities increased by $5.3 billion to $62.9 billion, and the owner's investment decreased by $0.9 billion to $11.2 billion. Now let's focus on what happened during 2016 between the two balance sheet dates. The statement of cash flows shows that PepsiCo generated $10.4 billion in cash from its operating activities having to do with the sale of its products and services. The company spent $7.1 billion in cash on investments like property, plant, and equipment, other companies, and intangible assets like patents. And PepsiCo paid a net amount of $2.9 billion in cash to parties who provided PepsiCo's financing, such as creditors and shareholders, the company's owners. This led to an increase in its cash balance of $0.4 billion, which partially explains the increase in PepsiCo's asset balance from January 1 to December 31. PepsiCo's income statement tells us that the company generated $62.8 billion in revenues from the sale of its goods and services, including soft drinks, energy drinks, and snack foods, while PepsiCo incurred $56.5 billion in expenses to generate those revenues. Such expenses included, for example, the cost of the product sold, wages and salaries, utilities, rent, insurance, interest on outstanding loans, and depreciation of the property, plant, and equipment. Revenue minus expenses led to a net profit or net income of $6.3 billion for 2016. This profit number represents a very important indication of PepsiCo's operating performance. By reporting positive profit, PepsiCo is showing that it has provided products and services to customers who are willing to pay more for those goods and services than it cost PepsiCo to provide them, thereby creating a return for PepsiCo's shareholders, who have the right to the net income because they own the company. The statement of owner's equity tells us what happened to the owner's investment during the year. Contributed capital decreased by $2.3 billion, primarily because PepsiCo purchased some of the company's outstanding stock back from its owners or shareholders. Earned capital increased by $1.4 billion because PepsiCo earned net income of $6.3 billion, and not all of it was paid to the owners in the form of dividends. $1.4 billion was left in the company. This must mean that dividends to the owners were $4.9 billion, the difference between net income and the increase in earned capital. The net result of the changes in contributed and earned capital is a decrease in the owner's investment of $0.9 billion, which explains the $0.9 billion decrease in the owner's investment on the balance sheet from January 1 to December 31. Now that we can, at least at a fundamental level, read PepsiCo's financial statements, let's begin to learn how to analyze them by addressing 5 basic questions. How profitable was PepsiCo? How large an investment in assets was required to create those profits? Where did these assets come from? How did PepsiCo manage its cash And how well did PepsiCo manage the investment made by its owners? The question, how profitable was PepsiCo, is answered simply by looking at the net income number. PepsiCo generated revenues from selling its goods and services that exceeded its expenses by $6.3 billion. Given that PepsiCo was profitable in 2016, a reasonable follow-up question is, how large an investment in assets was required to create those profits? Did it take a lot of resources to generate those profits, or a small amount of resources? This question can be answered by looking at the level of PepsiCo's assets. The two balance sheets show us that PepsiCo's investment in assets began the year at $69.7 billion and ended the year at $74.1 billion. On average, therefore, during 2016, PepsiCo maintained an investment in assets of about $71.9 billion. The beginning plus the ending balance divided by 2. Knowing that PepsiCo earned a profit net income of $6.3 billion, we can calculate that during 2016, PepsiCo earned a return on its asset investment of 8.8%. That is, return on assets, often referred to as ROA, was 8.8%. To gain some sense of whether this ROA is high or low, the previous year, 2015, PepsiCo reported an ROA of 7.7%, a full percentage point lower than it reported in 2016. And during 2016, Coca-Cola, a competitor of PepsiCo's, reported an ROA of 7.4%, 1.4% below PepsiCo's 2016 ROA. Thus, the efficiency with which PepsiCo is managing its assets seems to be both improving and better than a major competitor. To the next question, where did these assets come from? If we look at the balance sheets, we can see that there are two sources for the assets. Liabilities. Some of the assets came from loans provided by creditors, example, banks. Simply, PepsiCo borrowed to finance its assets. A second possible source of the assets is that they came from investments in the company made by PepsiCo's owners. The statement of owner's equity shows us that these investments can come in either of two forms: contributed capital, which represents direct investments into the company made by the owners, or earned capital, which represents past profits the owners have chosen to reinvest in PepsiCo. If for each balance sheet we take liabilities as a percent of assets, we find that as of January 1, liabilities accounted for 83% of PepsiCo's assets, changing to 85% by December 31. This means that during 2016, PepsiCo increased its reliance on liabilities as a source of financing its assets, or in other words, PepsiCo decreased its reliance on shareholder investments. As you can see, liabilities represent a clear majority of the company's capital structure. Therefore, the logical next question is, how did PepsiCo manage its cash? Is it able to meet the cash payments associated with the debt obligations? This question can be addressed by reviewing the statement of cash flows. We see first that during 2016, PepsiCo generated $10.4 billion in cash from its normal operating activities, the day-to-day selling of its goods and services. This number represents the net amount of cash remaining after subtracting the cash payments required to run operations from the cash proceeds collected from selling goods and services. Importantly, the $10.4 billion net number is after subtracting the cash PepsiCo paid for the interest charges related to its outstanding liabilities, which during 2016 were approximately $1.3 billion. This means that PepsiCo's operating activities generated much more cash than was necessary to cover the annual debt service costs. What then did PepsiCo do with all this cash? It invested $7.1 billion in additional properties, buildings, equipment, and other assets. These investments were made to help ensure that PepsiCo can continue in the future to generate a strong revenue stream. PepsiCo also used $2.9 billion of this cash to make payments to those who financed its assets, creditors, the parties who hold the liabilities, and owners. Examples include cash payments to creditors like banks to reduce liabilities, cash payments to pay dividends to its owners, and cash payments to its owners to buy back their stock. In the end, PepsiCo increased its cash balance by $0.4 billion, an amount that helped to increase the company's asset balance on the December 31 balance sheet. In summary, our review of the statement of cash flows indicates that PepsiCo is in a strong cash position. During 2016, it generated over $10 billion from its operations, enough to invest $7.1 billion in its future, pay almost $3 billion to its shareholders and creditors, while boosting its cash balance by almost $500 million. The fifth and final question is, how well did PepsiCo manage the investment made by its owners? This is an important question because a key goal of management is to properly manage the investments made by the owners and provide the owners with a satisfactory return on that investment. The answer to this question begins with a look at the investment made by the owners, which is reflected on both balance sheets and the statement of owner's equity. We see first that the owner's investment decreased from $12.1 billion as of January 1 to $11.2 billion as of December 31, a decrease of $0.9 billion. We see further that this $0.9 billion decrease is also indicated on the statement of owner's equity, and we also see on the statement of owner's equity that the increase was due to a $1.4 billion increase in earned capital minus a $2.3 billion decrease in contributed capital. Recall that the $1.4 billion increase in earned capital represents that portion of the 2016 net income left or retained in the business and not paid to the owners in the form of dividends. Had no dividends been paid to the owners, the entire $6.3 billion of net income would have increased earned capital. Recall also that the $2.3 billion decrease in contributed capital was due primarily to the fact that PepsiCo bought back from its shareholders a large amount of the company's outstanding stock. Interestingly, the cash paid to buy back these shares is also reflected in the financing section of the statement of cash flows. To assess how well the owner's investment was managed by PepsiCo's managers, we focus on the investment's rate of return. That is, what kind of a return did the owners earn on their invested capital during 2016? To answer this question, we first focus on the amount or size of the owner's investment, which on average was $11.65 billion, computed by dividing the beginning and ending balances of the owner's equity amounts on each balance sheet by 2. We then focus on PepsiCo's 2016 net income, which was earned for the benefit of the owners, and divide it by the average investment provided by the owners, leading to a rate of return for the owners of 54.1% for 2016. This return is called return on equity, or ROE, and it represents a very important indicator of the company's success, a key indication of whether the shareholders are pleased with management. The prior year, 2015, PepsiCo reported an ROE of 37.1%, which was considerably lower than the 54.1% reported in 2016. And during 2016, Coca-Cola reported an ROE of only 26.7%, which also was well below PepsiCo's reported percentage. As in the case of ROA, PepsiCo's 2016 ROE improved over 2015 as well as exceeded the ROE of a major competitor. To summarize the answers to our 5 questions and assess PepsiCo's financial condition and performance, we noted first that during 2016, PepsiCo earned profits of $6.3 billion. These profits were created by managing an average asset level of $71.9 billion, leading to a return on that asset investment of 8.2%. 8.8%, which compares favorably with the prior year and a major competitor. This asset investment was financed primarily by liabilities, growing during 2016 from 83% of the total assets to 85%. The shareholders' investment only accounted for about 15% of the asset base. The statement of cash flow shows us that PepsiCo is generating more than enough cash to meet the obligations associated with these liabilities, in addition to being able to invest heavily in the future and return large amounts of cash to the shareholders through dividends and stock repurchases. And finally, we see that PepsiCo created a return on the investment made by the shareholders during 2016 of 54.1%, which, like PepsiCo's ROA, compares favorably with the prior year and a major competitor.